Welcome everyone. Today we are going to talk about the three core types of market analysis. To understand why you need all three, I want you to picture a simple three-legged stool. A three-legged stool is incredibly stable. Each leg supports the others. But what happens if one of those legs is weak, or worse, completely missing? The stool becomes wobbly, unreliable, and will eventually collapse under any real weight. Well, in trading, your strategy is that stool, and the three legs holding it up are technical, fundamental, and sentiment analysis. If you ignore any one of them, your entire trading approach becomes unstable and is at a much higher risk of failing. A successful trader doesn't rely on one leg. They make sure all three are strong. So let's meet the three brains you need to develop to become a balanced and informed trader. First up is the Chartist brain, which is also called technical analysis. This is the study of price charts and the patterns they form. The core belief here is simple but powerful. The price reflects everything. All known information, every news report, every economic data release, and every ounce of market fear and greed. It's already baked into the current price. And because human psychology is constant, history tends to repeat itself in the form of recognizable chart patterns. Traders using this brain look at tools like candlestick charts, trend lines, and indicators such as moving averages and the RSI. Their primary goal is to identify high probability entry and exit points based on the story the price is telling. Let's expand the analogy. Think of a doctor reading an EKG machine to check a patient's heart. The doctor isn't necessarily asking the patient about their diet or stress levels at that very moment. They are constantly studying the lines and rhythms on the screen, looking for similar patterns that indicate health or disease. Similarly, a technical analyst studies the heartbeat of the market, the price chart, to diagnose its current condition and predict its next move. Now, let's switch to a completely different way of thinking, the economist brain, or fundamental analysis. While technical analysis looks at the price, fundamental analysis looks behind the price. It's a study of the economic, social, and political forces that actually drive currency values up and down. The core belief is that a currency's value is ultimately a reflection of the underlying health and future prospects of its country's economy. A fundamental analyst digs into economic reports, that's gross domestic product growth, inflation rates, employment data, and monitors central bank decisions on interest rates. They also keep a close watch on geopolitical events like elections or trade wars. Here's an expanded analogy to help you understand this. Imagine you're thinking of investing in a company. You don't just look at its recent stock chart. You'd do your due diligence. You'd read its financial statements, evaluate its business model, and assess the quality of its leadership. You're looking at the core fundamentals to decide if the company is truly valuable and has a strong future. In Forex, fundamental analysis is the same. You're doing a health check on entire economies to decide which currencies are strong and which are weak for the long term. Finally, we have the most often overlooked but equally crucial psychologist brain, or sentiment analysis. This is all about gauging the overall mood or feeling of the market. The core belief here is that markets are driven by the powerful emotions of fear and greed. And when these emotions reach an extreme, When everyone is overwhelmingly bullish or bearish, the market often becomes due for a reversal. Traders measure sentiment using tools like the Commitment of Traders report, which shows how different types of traders are positioned, or by gauging the tone in financial news and social media. Let's flesh out this analogy. Picture yourself walking into a packed stadium right before the big game. You can feel the energy in the air. If every single person is screaming, wearing the same team's jersey, and absolutely euphoric with confidence, that team's victory might seem like a sure thing. But for a contrarian, that peak of universal optimism is usually a warning sign. They know that when sentiment is that one-sided, there's almost no one left to become a new believer. And the smallest setback can cause a major shift. Sentiment analysis is your tool for filling the room in the financial markets, helping you avoid getting caught up in the crowd's frenzy. So, which one is the best? The truth is, that's the wrong question to ask. They are not competitors, they are partners. Each one answers a different vital question. Technical analysis tells you when. It gives you the timing for your entry and exit. Fundamental analysis tells you why. It provides the long-term reason and direction for a trade. Sentiment analysis tells you who. It reveals if the crowd is all on one side of the boat, risking a capsize. The ultimate goal is to become a unified trader, a person who can seamlessly integrate all three of these brains. You need the Chartist's eye for patterns, the Economist's understanding of value, and the Psychologist's feel for the crowd. Remember the three-legged stool. Don't let your trading strategy collapse because you neglected one of its essential supports. Master all three, and you will be on the path to making informed, balanced, and consistently successful trading decisions. Well, thank you so much for staying with me on this video. I will see you in the next one, where I will actually dive deeper into all these types of analysis that I've actually sufficiently talked of.